We've all seen the headlines. In the United States, the average 30-year mortgage just topped 7.6%. This is the highest reading since December 1st, 2000. From this vantage point, the situation has deteriorated. Everyone is now questioning how this market can possibly be steady. What began as a little inconvenience has now grown into one of the worst asset bubbles in financial history. Hello, and welcome back to Serious Coinage. Don't forget to like and subscribe to stay up to date on the world of economics. The tale of how we got here explains the future and raises severe warning signals about the future of this volatile economy. The impending housing catastrophe will be the worst we've ever seen, and to demonstrate why, we go back in time and examine strong evidence that what is occurring now is far from normal. Many individuals, will show you a chart like this to show you house prices throughout history. However, there is a significant error in this graphic. It misses the most crucial part of inflation. Over a 40 or 50-year period, the force of inflation is often underestimated. When someone says, "I bought a house in 2000 for $200,000, that doesn't always mean it's a good bargain. Because $200,000 in 2000 is equivalent to around $356,000 in 2023. That is, although this guy is up on his house on paper, it is not a genuine gain. So, in order to identify a bubble, we must account for inflation and demonstrate how much house values really increased. To do this, there is the inflation-adjusted Case-Shiller Index, which, without boring you to death, displays actual housing values. This chart will show us how housing prices are excessive without the deception of a declining dollar. And, as you can see, we have already eclipsed the last bubble, which was considered historic in US history. Indeed, we have reasonably solid data on home prices dating back to 1889, thanks to the pioneering study of Robert J. Shiller and Carly Case. And, as you can see, 2008 was a calamitous year. The cost of a house has risen to levels previously thought to be unattainable. And although there has been a tendency of rising real prices over the previous century, it is evident that the current bubble is worse than what we experienced in 2008. This period was thought to be normal, but since 2012, we've lost any sense of normalcy. So, what gives me the impression that we'll wind up back here? So, at some point in this debate, I believe the bulls lose their capacity to argue against the collapse. It all begins with some background information. The 2008 bubble began to form after the year 2000, which was not unforeseen. The reason for this was interest rates. When compared to today's norms, interest rates have been historically high. Rates have been slowly declining over the previous 30 years. This created the conditions for the 2008 bubble to emerge and burst. That, however, was not our lesson. After the 2008 bubble, the Fed continued to depress rates at historic lows. They eventually brought them down to 2.6%. And, of course, from late 2011 until present, they began a new bubble. Outside of the 2008 price increase, the true price of a property increased by 66%. This nation has never experienced such a quick acceleration, and each time it has occurred, we have watched a crash to bring this anomaly back into line with the historical norm. Now, if you look at this chart and think to yourself, wait a minute, that's not enough for me. Another body of evidence, in my view, is the last nail in the coffin. It basically shows that something must give in the market. Now, before I show you this feature, please take time to support the channel by clicking the like and subscribe buttons. Each like is a huge assistance to the channel, and I would be grateful if you could just take 2 seconds to push that button. Now, let me return to what I was saying. While interest rates have a significant impact on the housing market, we know that many purchasers and investors use a loan, often a 30-year fixed mortgage. Without going into too much detail, we know that the 30-year fixed rate mortgage is effectively a derivative of the 10-year treasury. Essentially, this financial instrument determines mortgage rates. Now, the issue is, what does this have to do with the value of my home? To answer this and eventually put the nail in the coffin, we must first comprehend the situation. Consider a 10-year treasury note to be the kind of paper that the government uses to borrow money. And how they do it is rather easy. They take your money with the promise of returning it to you with a little interest after 10 years. They are now paying a 4.5% interest rate. This is when things start to get interesting. There is also a 2-year treasury note with an interest rate of 5.02%, which indicates that the government is giving you a greater interest rate to borrow your money for 2 years instead of 10. Typically, it's intended to be the contrary, with the longer the government borrows, the greater the interest rate. An inverted yield curve occurs when interest rates are inverted in this manner. To summarize, inverted yield curves are the most evident indicator of a recession. When this occurs, the likelihood of a recession is practically 100%. Looking back to the late 1970s, every time the line fell below zero, indicating an inversion, there was a recession that followed. This was true in the 1980s, 1990s, 2000s, 2008, 2020, and today. The issue is seen when you zoom in. This chart is from 2022, so it doesn't represent the most recent changes. But we've gone even further into the inversion and are just beginning to recover. You could be thinking, well, we're getting back up, which is excellent news. We may have avoided the storm, but this couldn't be farther from the truth. The worst part, and when the recession usually begins, is when the inversion is complete and the line swings beyond zero and into positive territory. Consider the year 2008. The true agony occurred years after the inversion. We are now in a serious position. The Fed is raising interest rates to unprecedented levels, but the bond market is calling them on it. And this is the last point in terms of a potential collapse. For example, the 30-year yield is almost identical to the 10-year yield. This suggests that investors are beginning to anticipate significant inflation in the future. We know this because any logical individual would purchase a 30-year treasury if the interest rate was favorable. But they don't, since the following few years are so unpredictable. This is why purchasing the 10-year at the same return is achievable, because the 10-year requires an incentive to sell, and the incentive is a rate that is ludicrous when compared to the 30-year. It doesn't matter if you don't comprehend this portion. However, based on these treasury curves, investors will anticipate that inflation will remain high. And if that is true, you must conclude that if the Fed is hiking rates to combat inflation, ultimately the Fed will have to submit. And a crisis is required for this to occur. The catastrophe is directly in front of us. This machinery is responsible for the utter devastation of the housing market. Rates are like gravity, and we are now in uncharted terrain. When anything cracks, it will bring down this gigantic house of cards that has been developing since 2012, and the bubble that we thought was the largest will appear little in comparison. Before we go any farther, consider how the housing market crisis would affect homeowners and investors. It's not simply about rising interest rates and possible economic downturns. It's a major thing for everyday people and savvy real estate speculators. When interest rates rise, homeowners with adjustable rate mortgages or those wishing to refinance may face higher monthly mortgage payments. This might result in additional foreclosures and a slew of properties for sale at rock-bottom prices. Investors, particularly those who purchased homes expecting them to appreciate, may confront additional hurdles when prices fall. They may wind up with properties that are worth less than what they owe and generate less rental revenue. Thank you for taking the time to watch. Please remember to use the like and subscribe buttons if you enjoyed the video. We'll see you in the next one.